When the market is choppy, you're going to find that a combination of targets and candlesticks are going to work better. But, well, what I'm basically saying here is that not any one technique is going to be optimal all the time. Okay, I know you're probably not aware there was a big break there, but I've been taking some scheduled calls here. Okay, so hopefully that, Celia, that clears up a little bit more about the 8 and 2 issue. After the live event, you're going to see some special reports from me that deal with these kinds of issues in a lot more detail. Okay, so just be ready for those. Okay, and then the Admiral. Oh, it's been a long time since I've heard from you, Admiral. He's wondering about are the hands-on exercises going to be on the DVDs? Yes, they will. In fact, I was just talking with Barry about the live event, and they've got a really good way of putting my computer screen onto the DVD picture, and then they'll have a little picture-in-picture where you can see my face or whatever's going on in the room at the same time. So it should be a really good overall experience for everybody at home. And then we've got an email here from Harry O. And Harry is asking about the 3% calculation. And as I've said before, there are a lot of very high-powered concepts built into the course. One of them is this whole idea of money management. So if you only want to risk 3% of your account, let's say, and you have $3,500. In fact, let me grab my trusty calculator. So you've got 3,500 times 0.03. That's $105. Okay, so if you know that the most you can risk on any one trade is $105. What that means is, let's say you have a trade that you're looking to take, and you're going to have to take a 35 pip risk. Okay, and this assumes mini lots. Okay, hopefully you realize that if you've got an account size really under about 10 grand, you've got no business trading regular lots. Okay, so you should know ahead of time that these are mini lots. But what you want to do is divide 105 by 35. So how many of these 35 pip risks can I take? Because remember, if you have one mini lot, a 35 pip, whoops, my English friends will think that's 3.5. A 35 pip risk equals $35. 2 mini lots at 35 pips equals $70. And 3 mini lots at 35 pips, 35 times 3, just to make sure I don't mess it up, is, lo and behold, 105. Okay, so if you're taking a 35 pip stop, you're going to be able to trade 3 mini lots. Why? Because if you do take that loss, it's going to equal $105, which is exactly what you're trying to risk. So could you risk 4? What's 4 mini lots? 4 times 35 is 140. Now you see that violates your rule up here of 105. Okay, so if you can understand how this is a built-in check and balance. You don't have to worry about leverage. You don't have to worry about trying to calculate the pip value, or not the pip value, the margin requirements. You just are looking at how much can I risk and what's the total risk. I think it's a much more realistic figure. Okay, and you can do this at whatever number you want. You could make this 2%. I know some traders that will take a risk of 0.5% per trade. Okay, now you can do some of the math here. 3,500. If you're risking 0.05